Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 329 of the Independent Advisors Podcast. On today's show, I'll be covering a few important and timely topics. I'll be discussing the Japanese yields, the rising yields and the carry trade unwind panic that you've seen in the news headlines over the past week, how the Federal Reserve pivot has the potential to ignite a super cycle. I'll talk about how the market tends to react historically when the Federal Reserve is cutting interest rates in an expanding economy. And I'll even cover things such as what's some of these headlines about these new Trump savings accounts. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. Let's jump in. So in this week's podcast, I'm going to be handling this solo, and I'm going to use the opportunity to dig in a little deeper in a couple of those topics I previewed and go more than surface level. And I hope you learn a lot today. Let's start with pricing, as we normally do at the top of the podcast. I'm going to go through the indices and bond yields that we track on a consistent basis for our listeners and viewers. I'm going to dive right in. We'll start with the S&P 500 index, and all this pricing is as of December 4th, around 9:35 to about 9:37 a.m. Eastern Standard Time. S&P 500 index year to date up about 16.55%. Month to date, up 0.13%. The Dow Jones Industrial Average up 12.69% year to date, up 0.51% month to date. The NASDAQ Composite year to date up 21.43%, month to date up 0.43%. The IWM, which is an ETF that tracks the Russell 2000 Small Cap Index year to date, is up 13.79% and month to date up 0.29%. The Vanguard FTSE All World ex United States year to date ETF is up 29.79% and month to date up 0.58%. Pivoting and taking a peek at the Treasury markets, the 3-month T-bill currently yielding 3.70%, the 2-year Treasury yielding 3.51%, and the 10 years currently yielding 4.08%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
All right, so let's dig into big headlines and current events. I'm going to start with the November ADP employment change report that was released yesterday on December 3rd. It indicated that private sector employment shed about 32,000 jobs, and the consensus I believe was 20,000 positive, and that was following an upwardly revised 47,000 increase from 42,000 the month prior in October. Both goods producing jobs lost 19,000, service providing down 13,000. The key takeaway from the report was the understanding that small business establishments were down about 120,000, accounted for the entirety of the November decline. It was likely reflecting headwinds many are facing from higher cost and more guarded spending by low and middle income consumers. The probability of a 25 basis points rate cut going into next week's December 10th meeting is pretty high right now. As of yesterday, when I worked on this, again, timestamp that comment, December 3rd in the AM, was sitting at about 88.8% according to the Chicago Mercantile Exchange Fed Watch tool. So it's pretty high probability market expectations and money behind it in the interest rate futures predicting an interest rate cut next week. Now, on the flip side, the ISM Services Index data was also released yesterday on December 3rd. It's a widely watched gauge of how healthy the U.S. services sector is, and that ticked up again in November. It moved to 52.6, which is the highest reading we've seen in about 9 months. For context, anything above 50 means that the sector is expanding. Anything below 50 signals contraction. So the takeaway for me is the services side of the U.S. economy is still growing, not booming, not contracting, but but holding solidly in expansionary territory as we close out the year. So again, I think there is a lot of market participants trying to read the tea leaves on the economic data to see where we stand with this cycle. I am still in this camp, and I have not been shy about being vocal about this. In general, Wall Street has hated this rally since April. Yep, we had a little bit of a correction in November, but at the end of the day, I still feel, my personal opinion, equity allocations are on the light side. I think you're going to continue to see the market climb what I like to call a wall of worry going into the end of the year. So I'm going to pivot now, and I'm going to talk about tweets, articles, and research from this past week. And yes, I still call it tweets internally. I know it's X post. The first piece I want to cover for those that didn't see it earlier this week is a piece by Seth Golden related to how the market historically acts when the Federal Reserve is cutting rates and the economy is expanding. So if we think about this, the reason I selected this, because this was on my questions with Matt and Mark this past week, I do think it's important to highlight that it's very uncommon to see the Federal Reserve cutting interest rates when the economy is expanding. And we got to remember why that's the case. So the predominant reason is the Fed drastically raised rates a couple of years ago during the COVID pandemic to control inflation. The government printed a lot of money to sustain the economy. That caused a lot of inflation. The Fed had to react, raise rates to combat it. So in this piece that Seth had, he's going to show that in similar times when the Federal Reserve is cutting interest rates and the economy is expanding, the similar dates he indicated was January of 71, October of 1984, October of 87, July of 89, July of 95, September of 98, September of 2024, and just recently in September of 2025. The reason I'm highlighting this is when you look at those forward-looking returns in those similar circumstances, after that cut, 6 months later, on average, the S&P was higher about 14%, and 12 months later by about 16.5%. And the win rate, meaning the ratio of being positive in all those dates I mentioned, in both instances, 6 and 12 months, is 100%. So we got to be careful that I don't want individuals making sole investment decisions on single data points such as this. Doesn't necessarily mean that the market is guaranteed to be positive on a 6 and 12-month period when the Fed cuts and the economy is expanding. Of course it does not. But when you look at history through a guideline, through that lens, that's not bearish data. And that is one of the takeaways as a listener or viewer of the podcast. I just want you to realize the lens of history, not necessarily in the negative column. So the next topic that I think is kind of important to talk about is, where's inflation stand right now? So one of the research firms that I will reference from time to time, and if you're a regular listener of the podcast, you've heard me reference them in the past, is a research firm by the name of Trueflation. So Trueflation has their own basket of real-time prices that attempts to mimic the consumer price index, the government's basket of inflation. But Trueflation tries to report that literally almost on a daily basis through their research subscribers. What they're indicating is that the year-over-year change right now in the similar CPI, consumer price index basket that the government uses, same weightings, but utilizing more real-time prices, is indicating right now that inflation sits at about 2.32% year over year. So I I find this very interesting, and I want to bring it up because we've had so much inflation the last roughly 5 years that I feel as it's starting to level off. When I think listeners and viewers hear this, I want to make sure that they understand that I feel strongly we're not going to go backwards. I don't feel like we're going to exhibit deflation and we're going to start trying to repair this inflationary move that we've seen the past 5 years. But rather, the data is indicating to me that the inflation levels are normalizing. And that's important because the talk of the town right now is about the Federal Reserve. And if you have inflation running in this 2 to 3% range, but right now you got a Fed funds rate, the rate that they allow banks to borrow money from them, in the low fours, high threes, at some point that's got to normalize. And this is why you're starting to see higher expectations, not only for a rate cut coming next week, but a couple more coming in 2026. It's important you have that context because I have some other items next here about the Fed that is important. So since I'm doing the podcast solo, as I mentioned at the top, I want to go over two pieces or themes that I think the market is focused on right now. And one of those is in regards to the Federal Reserve. So let's go a little bit deeper under the surface. This piece I've titled The Pivot That Could Ignite a Supercycle. So this week, the financial markets got confirmation on something that's been quietly telegraphed for a couple of months, and now it's official. Quantitative tightening is ending here early in December, and it's marking the first time in nearly 2 years that the Federal Reserve is going to stop shrinking its balance sheet. And then just a few days later, coming up here next week, as I've said before on the podcast, on December 10th, the Federal Reserve is widely expected to cut interest rates again. You put those two policy shifts together, plus improving US China trade dynamics, and you can start to see why some analysts are talking about the potential for a new stock market supercycle beginning to form. So let's take some time, let's break this down. Catalyst number one, quantitative tightening is ending here in early December. The liquidity headwind is gone. So let's talk about this. The Fed has spent nearly 2 years running one of the most aggressive quantitative tightening programs ever. They were draining 1.6 trillion from the financial system. I want you to think of it as a headwind. QT was all about reducing excess liquidity, cooling inflation, and bringing the balance sheet back down to earth after the pandemic. The end of QT wasn't a surprise. Fed officials have been telegraphing for months that this quantitative tightening cycle would wrap up when bank reserves approached the lower end of ample. Money market signals like reverse repo balances falling towards zero were pointing to this moment. And the Fed wants to avoid a repeat of the 2019 repo crisis where they tightened too long and accidentally broke funding markets. So why does this matter? Because ending QT means liquidity stops shrinking. And historically, when liquidity stops falling, and especially when it begins to rise, you tend to get lower market interest rates, higher valuations, stronger risk appetites, and often the beginning of a durable bull market phase. So liquidity is the oxygen that markets run on. For almost 2 years, the Fed has been taking that oxygen away. And in early December here, that's reversing. So definitely a catalyst that I feel is being underreported at this time. Catalyst two, we have that other rate cut next week. There's a big misconception around rate cuts. People hear rate cuts and immediately think recession. And historically, that's not wrong. 8 out of the last 10 recessions began after the Federal Reserve cuts interest rates. And we've talked about this a lot since the evolution of the Independent Advisors podcast. And we've talked about how the market reacts after that first rate cut. But why the Fed cuts matters. If the Fed cuts because something breaks, that's bearish. If the Fed cuts because inflation is under control and they want to guide the economy towards a soft landing, that's bullish. And, in my opinion, that's the environment that we're in now. Growth is moderating, not collapsing. Inflation is trending downward. Talked about that a little bit ago. Financial conditions have eased. This looks far more like the mid-1990s rather than a pre-recession warning. Let's continue to move. Catalyst 3, the US-China truce, a direct shot at lower inflation. This third catalyst is the de-escalation of the US-China trade tensions. Tariffs have been cut from 20% to 10%. Even things such as the semiconductor NVIDIA export restrictions were delayed for another year. This will directly lower tech manufacturing costs, consumer prices, import inflation, and every point inflation moves down gives the Fed even more room to cut rates in 2026 if needed. So why does all this matter? This is a setup for the potential multi-year cycle. You rarely get all three of these factors at the same time. You got a liquidity pivot by the Fed. They're going from taking money out of the system, and they're actually going to start putting some money back in. Not a dramatic amount, but they're going to. A rate cut cycle beginning, and improving global trade dynamics that will help push inflation down. Now, on top of that, we still have record cash levels on the sidelines. You heard us talk about in the podcast many times over the past 6 months. You currently have over $7 trillion in money market assets. And as I've said, that money might be happy in the past earning 4+% risk-free, but what happens as those rates continue to come down? Corporate earnings expected to re-accelerate here in 2026. Talked about that a lot over the past couple of months. Household balance sheets, in comparison to history and the way that I'm viewing them personally, they're in pretty darn good shape. So none of this guarantees a straight up market. It never does. There's going to be volatility. There's going to be geopolitical noise. You're going to have the election year swings. We got to remember, I've talked about it. Of the 4-year presidential election cycle, year 2, the midterms, historically is the most challenging for the market. But markets trade on directional change, and the directional shift right now is towards more liquidity, lower interest rates, lower inflation, and a friendlier global environment for capital markets. You know, that's a combination that doesn't come around often. In fact, the last time we saw a similar alignment was in the mid-90s, which kicked off one of the most powerful multi-year bull markets in modern history. So whether you want to call it a super cycle or simply a major tailwind forming, in my opinion, the next few months could mark more of a psychological and structural turning point for the markets. This is why you tune into the Independent Advisors podcast.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
So the next topic that I want to pivot to and spend a little time on education, since I'm running the podcast this week solo, I want to talk about Japan. Japan's been in the headlines the last couple of weeks for those that are digging deep into the financial news headlines. And I want to talk about what's going on over there in plain English, because it is more of a complex topic. So this piece I've titled Japan, Rising Yields and the Carry Trade Unwind Panic. I'm going to explain it to you in plain English. So here we go. There's been a lot of noise online about Japan this past week. Rising interest rate yields, political changes, and warnings about a so-called carry trade unwind. And that could supposedly blow up the global markets. But if you peel back the headline panic, the real story is much more nuanced. It's not a crisis, in my opinion. It's more normalization. Let's break it down in plain English. First, Japanese yields on their bonds are rising for the first time in decades. Japan's 10-year government bond just moved up to about 1.9%. That's the highest yield on their 10-year since 2008. The 30-year is above 3%, and they have a 40-year over there, and that's near 3.7. These sound like small numbers, but remember, Japan has lived in a near zero interest rate world for more than 25 years. So these moves are enormous relative to their history. Secondly, why were the rates so low for so long? For decades, Japan battled deflation, falling prices, slow growth, demographic issues with their population's shrinking, and a mentality that prices would never rise. To fight that, the Central Bank of Japan, the Bank of Japan, went all in. Zero interest rates, negative rates at times, trillions of dollars of bond buying, yield curve control, and their central bank was buying half of all their outstanding Japanese government bonds. What was the results? Japan didn't have a bond market, it had a policy experiment. So what changed? Inflation finally showed up. Japan now has sustained 3% inflation, 40 plus months above their target, plus the strongest wage growth in 30 years. That's new territory for them. Meanwhile, the new prime minister rolled out a huge fiscal stimulus package, adding more debt at a time when yields are already rising. Put those together, and the market is basically saying the old regime is over, time to reprice everything. Fourth topic, why social media is most likely freaking out about this. Whenever Japanese yields move, people online are shouting things such as debt crisis, Bank of Japan is trapped, they're going to sell all their US Treasuries, the carry trade is unwinding. It's a simple narrative. It's just not the right narrative, in my opinion. Let's focus on the big one, something called the yen carry trade, because at the end of the day, in my opinion, this is really the one spooking the markets. So let's break it down. The Japanese carry trade in plain English. The Japanese carry trade is one of the biggest plumbing systems in global finance. Here's a simple version. Investors borrow in yen, the Japanese currency, where rates are basically zero or near to it. They convert the yen to dollars, buy higher yielding assets abroad, US Treasuries, corporate bonds, stocks even, and they pocket the difference. When Japanese rates rise or the yen strengthens quickly, the trade becomes less profitable. And when trade becomes less profitable, investors unwind it, which means what? They're forced to sell those foreign assets they bought. They're buying back the yen, causing volatility everywhere. It's happened before. In 2024, a surprise Bank of Japan move triggered a mini meltdown. We talked about it in the podcast at that time. The NASDAQ dropped double digits in weeks. Headlines: this is going to unwind. This is going to be the beginning of a global financial crisis. So the fear isn't crazy, just incomplete in my opinion. Next, is the carry trade unraveling now? Short answer, in my opinion, no, it's compressing, not collapsing. Here's why. Most of the hot money got washed out in 2024. There were a lot of hands on that hot stove that got burned. Speculative hedge fund carry trades, for the most part, in my opinion, they were shaken out last year. What's left today is mostly corporate hedging, long-term institutional flows, foreign direct investment. These flows don't dump positions overnight, in my opinion. The rate gap still favors the trade. Even with rising Japanese yields, you can still borrow yen at approximately 0.5%, buy US yielding assets in the 3 to 4% range. The spread is narrowed, but it's still positive. The adjustment's gradual, not a margin call event yet. Nothing in today's dynamics resembles a crazy disorderly unwind that would cause massive liquidations. And this to me is more of a slow normalization rather than a crisis. Meanwhile, the data still doesn't support a panic, in my opinion. One of the wildest claims online is that Japan is about to dump all of its US Treasuries, but the data shows opposite. Japan increased its Treasury holdings by 130 billion this year. If they were panicking, this would not be happening. So the real story, in my opinion, Japan is returning to normal. For 30 years, Japan suppressed the true cost of capital. Now that inflation's real, wages are rising, the Bank of Japan's backing off, the government's borrowing more, the yield curve is steepening, their bond market is rediscovering price discovery. Is it messy? And will it be messy at certain times? Absolutely. Are there risks like financial strain and bank balance sheet pressure? Absolutely. But in my opinion, this is not Japan blowing up. This is Japan joining the rest of the world again, where money costs something and the market sets prices. So I hope that you learned something from those two big topics. Since again, I was doing the podcast solo, it allowed me to go a little bit deeper into explaining the news headlines you might have seen about Japan over the past week. And I was happy to go in a little bit deeper and preview some of the headlines I think you're going to see about the Federal Reserve, not just over the next couple of weeks, but some of the narratives in Q1 and Q2 of 2026. And you've gotten your Cliff Notes executive summary ahead of time. So let's pivot, and I'm going to finalize the podcast with a financial planning topic this week. You've probably seen in the news things about these Trump savings accounts. You know, what are these new Trump savings accounts? So I'm going to dig into just the surface level of what I've learned, and I'm going to share it with you now. So the Trump administration recently announced a proposal for these Trump savings accounts. It's a new tax-advantaged savings vehicle aimed at helping American families save more efficiently for everyday financial goals. At a high level, these accounts would function in a very similar fashion to Roth-style savings tools. Contributions would be made with after-tax dollars. Growth would be tax-free, and withdrawals would also be tax-free when used for eligible purposes. What sets them apart is flexibility. Unlike existing accounts that are tied to specific goals like college, think of 529s, healthcare, HSAs, Trump savings accounts are designed to be broad purpose, covering a wide range of household needs. The proposal outlines several key features. First, wide range of eligible uses. Funds could potentially be used for things like home purchases, education, childcare, major life events, and even general financial emergencies, offering families more versatility than traditional savings accounts. Annual contribution limits. Early drafts suggest annual caps similar to IRAs, though the exact limits and phase outs based upon income levels are still being developed with my initial research. Tax-free compounding, like a Roth IRA, the emphasis is on the long term, tax-free growth. This is meant to incentivize consistent saving and reduce household financial vulnerability. You got some portability and ownership. The account would be individually owned and portable across jobs, custodians, and life circumstances. Next, no mandatory distributions. Current language indicates there would be no required minimum distributions, allowing savers to keep the money invested as long as they want to. Trump savings accounts are intended to be flexible, tax advantage way for Americans to save for major expenses throughout life, filling a gap between traditional retirement accounts and highly specialized saving tools. And I gave some of those examples earlier. I'm sure Taylor Ledbetter at the firm is going to have a blog post about this in the near future. I'm sure she'll be on the podcast as more details come out. I think it's an exciting development. I welcome it. It's another tool in the toolbox, and I think an important one that's going to be relatively mainstream, and we will learn more about that. So as I get close to the sign off of the podcast here of episode 329, just remember it's December 4th today. A lot of eyes on that Federal Reserve meeting next Wednesday, 2 o'clock, December 10th. It's going to be the focus and talk of the market leading up to that date. I thank you for listening, and we will be back next week with episode 330. Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of The Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.